Well, good afternoon. Thank you for taking the time to join me in my year-end client update titled Signals Are Flashing. Today's update is a follow-up from my June webcast titled Start Me Up. And it suggested that the Federal Reserve was likely done tightening monetary policy and that their next move would be to slowly begin the process of lowering short-term interest rates. Additionally, I noted that the bond market was likely to continue leading the direction of the Fed's monetary policy decisions, which forecasted the Fed's interest rate cut last month. I've also been noting the last few years that record levels of central bank gold purchases would likely push gold prices meaningfully higher. Among the reasons I expected this to occur is because as gold prices rise, central banks witness a recapitalization of their balance sheets that have largely remained underwater due to years of quantitative easing programs when interest rates were low. In a recent publication, the World Bank recommended a gold allocation of up to 22% of reserves. While many central banks are on the path to follow this guidance, institutional and retail investors remain largely unexposed to the asset class. Currently, gold's trading around $2,700 an ounce, which puts the reserve asset up over 30% on the year thus far. Today's webcast, like all of them, are being recorded and will be available for replay. As always, if you find today's content helpful but have questions about any of the content as it pertains to your investment strategy, don't hesitate to reach out to me or one of my partners following the webcast. Also, if you'd like an electronic copy of today's slides, let me know and I'll send you a copy. Going forward, I plan to make the recording links of past webcasts available when you request a copy of the slide deck. You'll just simply click on the webcast title if you want to go back and watch one. It'll take you directly to the recording link. Looking ahead to 2025, the dates for the webcast schedule have been set for those interested, and you'll see that at the bottom left part of the slide. So a reminder, these webcasts are designed to update clients that include accredited investors, high net worth investment advisory clients, as well as qualified plan sponsors and their plan participants. This is going to be a three-part presentation that provides an economic growth, inflation, and monetary and fiscal policy focused update in section 1. In section 2, I'll cover market risks and opportunities that I observe. And then third and finally, I'll provide a first half 2025 outlook. Keep in mind, I don't profess to know the future, but that doesn't mean we shouldn't study the past continuously and use the past as a way to manage risk in one's investment strategy. So with that in mind, let's get started. So to start, we're going to look at how the overall economy's been doing over the last several quarters as measured by real GDP growth. I think it's helpful to understand what are the things that determine this headline number called GDP, which is measuring the economy's growth. Well, they're the following. C stands for personal consumption, plus the addition of I, which stands for investment spending on fixed assets. G, which has been a huge influence, really going all the way back to 2008, stands for, if you might have guessed, government spending. And then finally, the addition of looking at the net exports. That's simply looking at taking the value of goods and services we export abroad minus anything that we import. So in short, you'll see on the bottom part of the chart, the economy continues to grow at a steady pace. But again, keep in mind that government spending's been a huge influence that may be vulnerable to meaningful cuts, which in my view are necessary. Any success in reducing the overall debt and annual deficit will detract from overall GDP growth in the near term. Yet it should be recognized that much of the government spending is unproductive and therefore not beneficial to the long-term health of the U.S. economy. In the bottom part of the chart, you'll see inflation data that goes back quarterly to the beginning, or excuse me, to the end of the third quarter of 2023. As I've noted in previous webcasts, inflation continues to moderate from its 9% peak reading that occurred in 2022, and it's slowly coming back to the Fed's 2% target. Speaking of inflation, speaking of the Fed and Congress's propensity to deficit spend, I thought it would be instructive to go back in time and listen to famous economist Milton Friedman and his views on the source of inflation. So take a listen.
Yes.
In a recent interview of U.S. News and World Report, Secretary of the Treasury Blumenthal blamed our current rising inflation in a large part on our foreign trade and unions. He did, however, say that the government was little to blame. Would you like to comment on that?
Yes. Unfortunately, it is one of the defects of our political system that we always put a Secretary of the Treasury and other high government officials into a position in which, when they make public statements, they are almost driven. Well, what's the word I want to use? I want to use a polite word, equivocate. Secretary Blumenthal knows as well as you and I do that inflation does not come from trade unions. That doesn't mean that trade unions aren't grasping. Of course they are. But they don't produce inflation for one simple reason. They do not own a printing press on which you can turn out green pieces of paper. The only such printing press is in Washington. I say printing press, of course, in the modern age, we do it in a more sophisticated way. We use bookkeepers and accountants and computers. But it comes down to the same thing. Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. Trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else. Yes, sir. Before you clap, let me point out that the reason why we have too much printed spending and too much printing of money is because you people want it. You and I. We're citizens. We run this country. If Congress has been voting higher and higher spending, why? Because it has been politically profitable for them to do it. If they have been voting higher spending and not voting the higher taxes to pay for it, why? Because it's been politically profitable to do it. We would all like to get something for nothing. And so the political process has been leading to Congress increasing spending, not increasing taxes, and financing the difference by the hidden tax of inflation. I think we are unwise. But let's not blame the others. The problem, you know, in that famous statement of the cartoonist, we have met the enemy and they is us.
Well, Solomon wrote, "There's nothing new under the sun." Clearly, that was just looking at the dated hairstyles. Had to have been from the 1960s or 70s. The slide focuses on the result of excessive amounts of COVID-related fiscal and monetary stimulus that caused the dramatic increase in the money supply that began in mid-2020. Budget deficit of nearly 15% of GDP in 2020, followed by a deficit of 12% in 2021. One of the largest back-to-back deficits as a percentage of the economy since World War II. The Federal Reserve, too, was to blame for keeping monetary policy too loose for too long back then. As a result, we witnessed a meaningful upturn in inflation that would follow over the next 24 months that led to that peak reading of 9% that I mentioned earlier during the summer of 2022. Now that the growth rate in the money supply is starting to come back to its prior trend level that you see here, we're seeing inflation readings start to moderate back down too. So as a result, I'm expecting to see inflation continue to trend lower in the coming year in 2025. Again, that doesn't mean prices are not going to go up. It just simply means they'll go up at a slower pace, most likely. Market participants remain optimistic that that'll be the case as well. They feel like we're going to see the Fed continue easing monetary policy in the new year. Currently, there's an expectation that the Fed funds rate will be 2 full % lower by July of 2025. Note any changes in inflation expectations to the upside, though, would obviously negate the pricing in these implied forward rates. Inflation and implied forward rates aside, it's common knowledge that the federal government needs lower interest rates for solvency reasons now more than ever. I mention this because interest expense at current rates has caused debt service to become the third largest single item in the budget and now consumes over 14% of all federal spending. This chart shows the importance of getting the federal budget that's outstanding, or excuse me, the federal debt that's outstanding down as a percentage of the economy's output. Doing so will put the longer-term health of the economy on better footing. As long as inflation continues to moderate and the outlook for the higher quality parts of the bond market remains bullish. I noted a year ago that the bond market was priced to deliver equity market-like returns. Generally speaking, most sectors of the bond market have in fact delivered 10 to 12% returns over the last 12 months in line with those expectations. This being noted, I continue to wonder if the long-term bull market in bonds that started when interest rate peaked with inflation in 1980 is not over yet. Many in the industry assume the record low interest rates that occurred during the 2020 COVID shutdown will never be witnessed again. During that year, bond prices reached all-time highs in price, as evidenced on this chart, when the 30-year Treasury price peaked at 185, where you see that right there. Note a similar occurrence happened in 1978 when the U.S. long bond reached just over 77 and then began to fall to 44 by the peak inflation year that happened in 1980. Interestingly, this was the same percentage decline for the long bond in price from the 2020 peak of 185 to the 2023 low when it hit 107. Thus, I wonder if a similar recovery in long bond prices is going to materialize in coming quarters, particularly if inflation readings and government deficit spending decline in coming years. The scenario would make the longer duration part of the U.S. Treasury market attractive from a risk-reward perspective. Turning to the stock market, the U.S. stock market's on track to post a second year in a row of 20+% returns. Coming off the inflation-induced decline in 2022, a recovery was unsurprising to me once interest rates stopped going up. But we're clearly back into bubble territory, particularly for the mega cap names in the U.S. indices. This slide contains the NASDAQ index, which has the greatest weighting to the mega cap names. And I just want to draw your attention to the fact that the index is now up over 20 times since the 2008 financial crisis low. And the uptrend is clearly still intact, but from a risk management perspective, I would have an exit strategy in place if prices fall below this rising red trend line that you see here at some point in the new year. Another chart that I've mentioned in the past webcasts that I've done here recently is this comparison to NVIDIA today to Cisco Systems 24 years ago. Both companies have been true innovators in the technology space and as a result experienced tremendous sales and earnings growth. However, we also know from this chart with the benefit of hindsight that investors got overly optimistic on Cisco's growth prospects back then. For example, Cisco's Q1 2000 earnings release disappointed investors' expectations, and as a result, the stock price would collapse 90% over the next 2.5 years as the tech bubble burst. Today, I wonder if NVIDIA will face the same fate at some point in the new year because of its lofty valuations. And it's not just NVIDIA that's showing signs of froth in terms of expensive valuations. Each of these mega cap names you see listed in this box are trading at historically expensive valuations that's higher than those witnessed during the technology bubble 24 years ago. Back then, the 10 mega cap names would decline anywhere from 60 to 80% between 2000 and 2003 and not fully recover those price peaks until 13 to 16 years later, depending on the company. So again, the takeaway here is that if you own these names either directly or indirectly, I would employ a risk management strategy that if a similar post-2000 tech bubble outcome materializes sometime in the new year or maybe in 2026, that your portfolio is unlikely to be meaningfully impacted in a negative way. In these next few slides, I want to focus on the signal that's coming from the bond market, from the yield curve, and the historical equity market correlation that can result from a complete de-inversion of the yield curve. As a reminder, the yield curve is simply a way of determining if bond market participants believe that financial conditions are loose, neutral, or restrictive. So let's talk about, for newcomers to the yield curve, and what that means, what that looks like, and what I'm referring to. So at the top panel of this chart, this black and red line is what I call the yield curve ratio. I'm looking at the difference in yield between the 2-year Treasury note and the 10-year Treasury note. Anytime you see the 2-year Treasury note have a higher yield than the 10-year Treasury note, this indicator is going to fall below this red horizontal line. It's set at 0, because when that ratio of taking the 2-year divided by the 10-year goes below 0, that's telling you that the ratio is going to be negative. Also, I want to note that when that happens historically, that's an indication that the bond market thinks that financial conditions are restrictive. And notice my note to myself as an investor: reduce equity exposure. Conversely, though, when the yield curve is steep, which means that the bond or the yield on the 2-year Treasury note is well below the yield on the 10-year Treasury note, that's an indication that financial conditions are loose. And you see that anytime this black and red line is above the green horizontal line. That's when it's above about 2% spread in terms of the difference between the 2s and the 10s. And I point that out simply as an indicator to look at in light of what the stock market historically does during these time frames, because the blue line you see here is the S&P 500. I'm just using that as my reference to the stock market. Anytime you see the yield curve stay steep for an extended period of time, that's a favorable environment for the equity market. And so notice the stock market tends to go up while the yield curve has been steep for a while. And then even as it gets less and less steep and becomes neutral and eventually becomes restrictive. However, once the 2s versus 10 indicator has been restrictive for a long enough period of time, you usually start to get in trouble with the stock market historically. And so back during the tech bubble, the yield curve had been inverted for not quite a year, but that was long enough for the stock market to no longer go up. And you would see the tech bubble burst with a 50% decline of the S&P 500 until such time the yield curve would uninvert and get loose enough, long enough for the stock market to be able to recover, since financial conditions would be loose enough, long enough. That would repeat again coming out of that decline in 2003's low into the 2007 peak. By then, the stock market will have doubled. And then once again, financial conditions will have finally gotten restrictive again long enough for the stock market to peak. We see a 58% decline going into the low of 2008 over 18 months. However, financial conditions get loose again as short-term rates fell a good bit versus long-term rates and stayed there long enough for the stock market to recover. Now, I want to point out the S&P 500 is clearly still in a rising trend. So this indicator is not telling you to get out of the stock market today. I would just simply tell you that now that the yield curve is starting to uninvert, in the event between now and some point in 2025, you see the S&P 500 fall below this rising red or black trend line that's been in place since the 2008 low. I wouldn't assume that it's just another run-of-the-mill correction. In the given year, the stock market corrects as much as 15% and then begins to resume a trend higher historically. However, there are these points in time historically where you can see something worse, and I'll talk about why I could foresee something deeper than that happening in coming slides and why. Yield curve inversion history is really what I want to focus on in these next 2 slides. So the yield curve inversion that we've been witnessing has been the longest on record, even going all the way back to the peak leading up to 1929. You can see others that have happened in 1973, 74, leading into that was a recession. 1980, we saw a recession. Each of these, you typically see a recession with some type of equity market correction. And so I'm pointing these out for that reason. And really what I want you to understand is that even though it can always be different, I wouldn't count on it being different from history being my base case. So what do I mean by different? Well, when you look at these inversions and how long they last, the longer the yield curve inversion historically, the greater the risk that the equity market correction is going to be bigger than normal. So for example, in 1989, 1969, and 2020, the yield curve had not been inverted very long. It was between 150 and 200 days in each of these episodes. And over here, what you're seeing is how much the stock market declined. 20 to 30% was what you witnessed. But if you look at historically important points in time where the yield curve would be inverted for longer periods of time, you'll notice that there's a direct correlation with a bigger drawdown that would come in the stock market. So for example, in the year 2000, the yield curve had been inverted for not quite a year. That was a 50% drawdown, as I mentioned before. 2008, the yield curve had been inverted for over 500 days. The stock market was down closer to 60% in that episode. And again, we're at this outlier of something that's never happened before, where now the yield curve's been inverted for well over 700 days. The only other outlier that's really on that same area is 1929, which again, it's not a forecast for a depression. I'm just trying to suggest that once we see the equity market eventually correct, you might want to take some risk management decisions if you hold a meaningful amount of assets in those names that are the most expensive, that have the most, to me, potential for larger drawdowns. Now, are there other areas of the equity market to invest that may not have that drawdown potential, such as those mega cap names in the S&P and the NASDAQ? The answer is yeah. How do you go about screening for those if you want to own equities? Well, I would simply want to go screen for equities that offer, as I've said in previous webcasts, attractive free cash flow yields that are well above money market rates and other fixed income yields. Today, the Russell 1000, the S&P 500, and certainly the NASDAQ do not meet these criteria presently, as evidenced by the free cash flow yield on the Russell 1000, which is still well below a money market rate. So you got to consider in sector investing within the equity market universe to find more attractive cash flow yields. And of interest, Berkshire Hathaway's Warren Buffett largely uses this and other similar metrics for allocating Berkshire's reserve capital within the equity markets. And I would note that presently Berkshire holds a record level of cash and percentage of cash relative to any other time in their history right now. Personally, for me, I'm limiting my equity exposure to the precious metals mining sector because the sector offers the highest cash flow margins, which is providing attractive cash flow yields at the moment. I mentioned that also, whereas right now we're watching gold and silver remain in uptrends that appear to be forming bases that suggest that the next move higher might be a parabolic move higher. Companies that mine gold and silver, too, remain in uptrends, as evidenced by this gold line that you see on the chart. And I want to point out the fact that unlike more traditional indices like the S&P 500 and the NASDAQ, notice that the precious metal mining sector tends to correlate with the direction of the yield curve. So if I expect the direction of the yield curve to uninvert and financial conditions eventually go from being restrictive, which they still are, to neutral, which they're on the way to starting that direction, to eventually getting loose, you'll notice on that chart that that's the direction of the precious metals mining sector historically. So for example, 24 years ago, when the NASDAQ index went down 80% as the yield curve loosened and steepened, this sector of the market would go up fivefold while that happened. So will that happen again? I don't know for sure, but that's what happened not only then, but also post-2008's financial crisis. And now we're starting to witness that again as the yield curve is becoming less restrictive. So that's why I'm putting my money in that sector. Let me make one other comment that I hadn't talked about in a while. And occasionally I get this question about what I feel about Bitcoin and crypto in general. I would just say this for the sector. This is not really about the long term. It's just making an observation about the short term. If I'm concerned about the S&P 500 and the NASDAQ being vulnerable to earnings disappointments, which might lead to bigger than normal drawdowns in the coming year, I should necessarily be thinking that crypto may go with it. And the reason why I say that is that if you look at this chart of the NASDAQ, which is this red and green line that you see going back to 2017, the blue line is Bitcoin. You'll notice that there's a very strong correlation to the direction in the near term of the NASDAQ, and for that matter, the S&P 500 and the Bitcoin price. That's true for other crypto assets as well. So Bitcoin obviously has done much, much better than the stock market and will likely continue to do so if the stock market keeps moving higher. But in the event we witness some type of meaningful correction in coming months in the stock market, I would fully expect that Bitcoin and other crypto assets will actually go down more than the stock market. So I'm just mentioning that only because that's what's happened historically. In summary, I believe in 2025, we'll witness continued growth, albeit at moderate growth rates that will allow for a continued loosening of monetary policy. Mega cap stocks, as I mentioned before, and the indices that hold them are the most vulnerable to downside risk if earnings growth assumptions disappoint in coming quarters. Also, a coming need to suppress interest rates to maintain a semblance of solvency for the U.S. government will likely be a tailwind, not only for interest rates going lower and staying low, but also for gold and silver prices in coming years. In closing, I'm providing a few additional resources for those of you that may be interested. Number one, if you request a copy of my slide deck, when you click on this link on this final slide, Judy Shelton, for those of you that don't know who she is, she's a candidate to replace Jay Powell, the chair of the Federal Reserve. I bring up her name because she's a firm believer of sound money, and sound money is a reference to perhaps going back to some type of fractional gold standard for the government. She's a firm believer in that, so I thought that interview might be of interest. The second one is for those of you that are interested in going back over what I talked about with the history of the yield curve inverting and the impact on the stock market that we've witnessed as it uninverts historically with drawdowns. You can find a little bit more detail in about a 5-minute video on that link there. Also, finally, for 401k investors who direct their own accounts, to the extent that you own high-quality bond funds for income and stability, my advice continues to recommend keeping an allocation to them. And to the extent that you own equities, avoid low free cash flow yielding equities, such as those found in a large cap U.S. equity fund. When available and to the extent your risk tolerance allows for it, do consider gold and precious metal exposures if you don't already have any. For clients, if any aspects of today's content makes you want to schedule a review, don't hesitate to reach out to us at your convenience. And for non-clients, if you'd like to explore how to put these themes to work, let us know. We can set up a time to evaluate how to implement these risk management ideas into your investment strategy in more detail. Thank you for taking the time out of your day to listen in. My next webcast, as I mentioned at the beginning, is scheduled for Wednesday, June the 11th. I hope you and your family have a great Christmas and New Year celebration in coming weeks. And with that, I'll say goodbye for now.